Everyone thinks World War II was inevitable because of ideology. Hitler, fascism, nationalism, old grievances. That's the version you get in school. But look closer and you notice something strange. The world didn't just stumble into the most destructive war in human history. It accelerated into it. Right at the moment when the global financial system of the 1920s had begun to collapse under its own weight. And here's the paradox nobody tells you. The very institutions designed to prevent economic chaos, the central banks, the gold standard committees, the Bank of England, the Federal Reserve, were the ones who needed a liquidation event massive enough to reset the entire system. A reset big enough to wipe out unpayable debts, dissolve impossible political promises, and create the space for a new monetary order. War didn't just happen. War solved a problem. This sounds uncomfortable, almost conspiratorial, until you look at the numbers. By 1931, Europe's banks were suffocating under interwar debts. Germany owed reparations it could never pay. Britain owed the United States money it could never repay if Germany didn't pay its debts first. The United States had lent billions in the 1920s that were no longer coming back. Every major central bank pretended the gold standard still worked, even as gold reserves evaporated and credit froze. The math was simple. The world owed more dollars, pounds, and marks than there was gold to cover them. So governments did what governments always do when the math turns fatal. They stalled, they improvised, they blamed political enemies. But by the mid-1930s, it was clear something deeper was happening. The system built after World War I was breaking apart, and without a complete restart, a hard reboot, no country could climb out of the deflationary spiral without triggering someone else's collapse. War became the release valve. A brutal industrial release valve, but a release valve nonetheless. It allowed governments to suspend convertibility, seize gold, print money, impose controls, erase old treaties, and rebuild economies under emergency powers. The destruction of old factories created demand for new ones. The destruction of currencies made room for new monetary doctrines. And after enough ruins had been cleared, the winners gathered in Bretton Woods in 1944 to design a new financial architecture that the old world would never have accepted voluntarily. You don't have to believe in evil masterminds to see it. You only need to follow the incentives. Systems don't collapse because of bad intentions. They collapse when their numbers drift too far from reality, and the people in charge choose the only reset button big enough. When you rewind the clock to the early 1900s, you find something surprising. The world didn't drift into financial chaos by accident. It was engineered, piece by people who believed they were building the safest, most rational monetary machine ever designed. And on paper, it looked perfect. But perfect systems are the ones that break the most violently. Imagine the year 1913. The United States creates the Federal Reserve. The Bank of England, still the world's conductor, manages the international gold standard with a confidence that borders on arrogance. France rebuilds its gold reserves. Germany industrializes at record speed. Everyone believes gold is the anchor of civilization. Money is just a receipt for metal sitting in a vault. That's what they told the public. But behind closed doors, central banks were already pushing the boundaries. They discovered that if you keep only a fraction of real gold and expand credit far beyond it, the economy grows faster. The trick was to maintain trust that the gold was somewhere, trust that the system was stable. By 1914, the global economy was running on a kind of polite fiction, more paper claims on gold than gold itself. And fiction becomes dangerous when everyone believes it literally. Then World War I detonated. Nations suspended convertibility, printed money, borrowed like never before. Britain issued more than £2 billion in war loans. Germany financed its war machine with massive deficits, expecting victory to pay the bills. The United States extended billions in credit to allies. It was the world's first modern debt supercycle. And when the guns stopped in 1918, everyone expected the old pre-war gold system to magically return. But the numbers were different now. The war shattered the balance sheet of the planet. Germany owed reparations to France and Britain. Britain owed the United States. The United States expected repayment in gold, but the gold didn't exist. So between 1920 and 1928, central banks tried to rebuild the system using a hybrid model historians politely call the interwar gold standard. In reality, it was a gold standard in name only. Britain returned to gold at the old pre-war parity in 1925 under Chancellor Winston Churchill, a heroic gesture but economically suicidal. The pound was far too strong for Britain's weakened economy, so exports collapsed. Meanwhile, the Federal Reserve kept rates low to help Britain, pumping credit into the U.S. market. The result was the great asset bubble of the late 1920s, the roaring stock boom, fueled by cheap money protecting a political illusion. Look at the structure. The Bank of England depended on the Federal Reserve. Germany depended on American loans to pay France. France depended on German reparations to rebuild. Every country depended on everyone else pretending the system worked. It was a financial Ouroboros, a snake eating its own tail, powered by circular debts and fragile promises. The Bank for International Settlements was created in 1930 to manage reparations. It was sold as a neutral institution. In practice, it was a clubhouse for central bankers to coordinate rescues behind the scenes. Its founders, Montague Norman of the Bank of England and Hjalmar Schacht of the Reichsbank, believed central banks should operate above politics. That sounds noble until you realize above politics meant unaccountable. By this point, the world economy was like a cathedral built on wet sand, beautiful, intricate, mathematically elegant, and doomed. All the key players knew it. But no one wanted to be the first to admit the gold reserves were insufficient, the debts unpayable, the currencies misaligned. Trust was the only pillar holding everything up. Then 1929 hit. The crash didn't break the system. It exposed the cracks already there. And once trust evaporated, governments scrambled. The Austrian bank Creditanstalt failed in 1931. Germany froze payments. Britain abandoned the gold standard that same year. The United States clung to it until 1933, when Roosevelt confiscated gold from citizens and devalued the dollar. It was a global financial civil war, each nation saving itself at the expense of its neighbors. By the mid-1930s, the mechanism built to stabilize the world had become a trap. Currencies competed in devaluations, trade barriers rose, credit dried up. The financial architecture that central banks had designed after 1918 had entered a death spiral. Politicians blamed communists, capitalists, foreigners, minorities, anything except the arithmetic they had created themselves. And that's the key to understanding why the 1930s felt like a slow-motion collapse. It wasn't ideology pulling nations apart. It was a system whose internal math could no longer sustain itself. The promises were too big. The gold was too small. The debt too interconnected. The illusion too fragile. If this revealed something new about how the global system was built, tell me where you're watching from. If you lived in the late 1920s, you would have sworn the world had finally cracked the code of prosperity. Newspapers talked about a new era. Economists insisted crises were a thing of the past. Central bankers, riding high on prestige, believed their coordinated policies could smooth out every shock. It felt modern, scientific, controlled. But illusions are strongest right before they break. The illusion began with confidence in the reconstructed gold standard. Britain had returned to gold. France kept accumulating gold reserves. The United States held more than 40% of the world's monetary gold by 1927. On the surface, the system looked stronger than ever. But underneath, gold had become more of a symbol than a constraint. Paper claims kept multiplying, credit kept expanding, and central banks found new ways to bend their own rules. The world was living inside a beautifully decorated balloon, and the more air they pumped in, the higher everyone felt they were flying. In America, the Federal Reserve cut interest rates to support Britain's too strong pound. Cheap money flowed into the stock market. The Dow Jones tripled between 1924 and 1929. Ordinary citizens borrowed on margin, buying stocks with 10% down, assuming they would rise forever. Bankers extended loans to foreign governments on similarly optimistic assumptions. The cycle fed itself. Rising markets attracted new credit. New credit lifted markets further. Everyone believed they were richer, though no new gold had been mined to justify the explosion of paper value. Germany, despite reparations, entered a golden-looking decade thanks to American capital. Shiny new factories appeared in Berlin, Dresden, and the Ruhr. It felt like a comeback. Politicians bragged. Newspapers celebrated. Few understood that the prosperity was rented, not earned. The dollars flowing in were not income, they were loans. Loans that required future payments in gold or dollars Germany simply didn't possess. France enjoyed a different illusion. As German money flowed in, France bought gold aggressively, turning the franc into one of the world's strongest currencies. A strong currency feels like national dignity, but it also strangles exports and encourages hoarding, and the Banque de France hoarded almost a quarter of global gold reserves by 1932. The strong franc was less a sign of health than a sign of imbalance. Look at the dance. The United States lent money to Germany. Germany paid reparations to France and Britain. France and Britain used that money to pay war debts to the United States. The circle looked like growth, but no new wealth was created. It was a closed loop, a beautiful merry-go-round powered by borrowed dollars. Meanwhile, the average citizen felt the glow of the boom. Radios, cars, home appliances, mass production created the illusion of endless prosperity. When you walked into a department store in 1928 and saw refrigerators and vacuum cleaners lined up like trophies of modernity, you didn't think about central bank gold ratios. You thought, we'll never go back to the old world again. That's how illusions work. They turn temporary abundance into permanent belief. But illusions need guardians. The illusion of the 1920s was guarded by central banks promising that every paper note was backed by gold, even though nearly everyone who mattered knew the numbers didn't align. They called it management. They called it stabilization. But stabilization meant manipulating interest rates, sterilizing gold flows, and quietly coordinating actions behind closed doors. Montague Norman at the Bank of England and Benjamin Strong at the New York Fed were the high priests of this illusion. They believed central banks could, through subtle adjustments, maintain growth without inflation, stability without sacrifice. They were wrong, but their confidence was contagious. What makes this era fascinating is not that people believed in a lie. It's that the lie worked for a while. Just like the South Sea bubble, the assignats of revolutionary France, or the housing market in 2005, the numbers all made sense on the way up. The charts all rose, the politicians all smiled. As long as everyone agreed to pretend that debts would be paid, gold was sufficient, and prosperity was permanent, the machine continued to hum. But every illusion has a tipping point, and in the late 1920s, the math began to whisper warnings. Gold wasn't flowing where it should. Credit was growing faster than trade. Germany was relying on new loans to pay old ones. France's hoarding drained liquidity from the system. Britain's overvalued pound bled gold to the United States month after month. The machine started to vibrate. People didn't notice the vibration. They noticed the music. That's what happens in every bubble. The show distracts you from the pistons overheating behind the curtain. The illusion of the interwar boom was not unique. We saw it again in Japan in the 1980s, in the dot-com bubble, in the mortgage market before 2008. The formula is always the same. Cheap credit creates temporary abundance. Temporary abundance creates belief, and belief fuels even more credit. Systems don't collapse when people lie. They collapse when too many people believe something that isn't true. The illusion didn't die in a single moment. It eroded, like a bridge that looks stable until the final bolt snaps. And when that bolt finally breaks, people call it a shock. But shocks aren't sudden. They're delayed math. By late 1929, the math was impossible to ignore. Credit had grown faster than gold. Debts had grown faster than incomes. Promises had grown faster than the ability to fulfill them. The stock market crash in October wasn't the cause of collapse. It was simply the first place where belief failed. A few investors tried to sell. Others followed. Suddenly, everyone wanted dollars, not promises. They didn't trust the system's ability to keep the illusion intact. Think of it like a bank run, but at the scale of the planet. Once fear entered the equation, everything that had been hidden became visible. Germany's reliance on American loans, Britain's overvalued pound bleeding gold to New York, France's hoarding draining the global monetary pool. The beautiful circular flow of reparations and war debt payments broke the moment one link snapped. When American banks stopped lending abroad in 1930, Germany couldn't pay France, France couldn't pay Britain, Britain couldn't pay the United States, and the entire global financial architecture seized up like an engine without oil. Then came the moment that exposed the core weakness, the Kreditanstalt collapse in May 1931. This Austrian bank wasn't a local institution. It was deeply tied to German, British, and French creditors. When it failed, the panic it triggered rippled through Europe. Depositors stormed banks, gold flowed out of central bank vaults. Politicians scrambled to reassure the public. But reassurance doesn't refill empty vaults. Within months, the British government abandoned the gold standard, ending more than a century of monetary orthodoxy. They didn't do it because they wanted to. They did it because the arithmetic left no choice. The Bank of England's gold reserves were vanishing, a run not by citizens but by foreign central banks and private holders who no longer trusted Britain's ability to defend the pound. That's an important detail. The run was international. It was central banks losing faith in one another. When nations stop trusting each other's money, cooperation collapses. The United States clung to gold for 2 more years, insisting on discipline while its own banks failed by the thousands. Between 1930 and 1933, more than 9,000 American banks shut their doors. People lost their savings. Companies lost their credit lines. The Federal Reserve, trapped by its own doctrine, refused to expand money because it feared losing gold. So the United States entered the worst deflation in its history, not because of some mysterious economic curse, but because the rules of the system forbade survival. Roosevelt broke those rules in 1933. He confiscated gold from citizens, devalued the dollar from $20.67 per ounce to $35, and declared that gold could no longer be demanded in exchange for paper money. It was a revolution disguised as monetary reform. And the public accepted it because the pain of staying within the old system had become unbearable. Every major economy followed a similar path. Abandon gold, reflate money, impose capital controls, devalue currencies. But once every nation was acting in its own interest, the world economy fractured. Trade barriers rose. Tariffs intensified. Exchange rates became weapons. Economic nationalism fed political nationalism, and political nationalism fed war. Here's the part people struggle to accept. Central banks understood the mathematics before most politicians did. They knew the interwar gold standard was unsustainable. They knew the debts couldn't be honored. They knew credit had expanded beyond reserves. They spent the 1930s improvising, coordinating in secret, and trying to prevent a total meltdown. But they also knew something else, something darker. A system like this doesn't die quietly. It requires political permission to rebuild. And political permission in the 1930s rarely came without catastrophe. Economic collapse radicalized Germany. It hardened Japan. It pushed Britain and France into rearmament. It convinced Roosevelt that only massive government spending, first through the New Deal, then through wartime mobilization, could drag the United States out of deflation. By 1939, the global economy had already collapsed. The war that followed didn't destroy the system, it cleared the ruins. It erased the old debts. It mobilized idle factories. It allowed governments to print limitless money without public resistance. And when the ashes settled, the architects of Bretton Woods built the new monetary order the old world would never have accepted peacefully. Numbers broke the illusion. Politics broke under the weight of numbers. And war swept away the broken pieces. When the smoke cleared in 1945, the world told itself a comforting story, that the war had ended one era and started another. But the deeper truth is that the war reset the global balance sheet. It wiped out obsolete debts, destroyed excess industrial capacity, and gave central banks the blank slate they had needed since 1931. Out of that blank slate came a new financial architecture, Bretton Woods, a system built not to prevent crises, but to channel them in controlled ways. Look at the mechanics. The United States emerged holding roughly 2/3 of the world's gold supply. Europe was in ruins. Asia was rebuilding from nothing. This imbalance allowed the United States to dictate the rules of the new monetary order. The dollar became convertible into gold at $35 per ounce, but only for foreign governments. Everyone else used dollars as if they were gold. It was a clever trick, a gold standard without the constraints of a real gold standard. The world accepted it because there was no alternative. Europe needed American loans through the Marshall Plan. Japan needed American markets. Britain needed American support to maintain even a shadow of its former empire. Bretton Woods wasn't just an agreement, it was a dependency system. The global economy orbited around the Federal Reserve like satellites around a planet. But the seeds of the next crisis were already there. The post-war boom of 1945 to 1970 created an illusion similar to the 1920s, only bigger. Factories reopened, consumption exploded, the middle class expanded. Governments promised pensions, healthcare, education, all funded by perpetual growth. And as long as the United States could print dollars and everyone else recycled those dollars back into American assets, the machine worked. Then came the familiar pattern. Credit grew faster than gold. Dollars flooded the world. By the mid-1960s, the United States had created nearly 4 times more dollar liabilities than it had gold to back them. It was the interwar illusion all over again, but on a global scale. France noticed first. Charles de Gaulle in 1965 accused the United States of exorbitant privilege and began demanding gold for dollars. Other nations followed. Gold drained from U.S. vaults just like it had drained from London in 1931. The pattern repeated like an echo. Overvalued currency, foreign creditors demanding repayment, gold reserves falling, political leaders denying the problem, and finally, a breaking point. In August 1971, President Nixon did what Roosevelt had done in 1933. He killed gold convertibility. The dollar became pure fiat. Bretton Woods died. The world entered a new era. Floating currencies, uncontrolled credit creation, expanding sovereign debt. But the logic behind the system remained unchanged. Governments promise, central banks accommodate, the public believes. And just as in the 1920s, illusions grow until they break. You see the modern echo everywhere. After the 2008 financial crisis, central banks printed trillions to stabilize markets. After 2020, they printed even more. Governments issued debts they can never realistically repay without inflation or restructuring. Asset prices rose far faster than productivity. Housing in many countries became a speculative instrument rather than a place to live. Stock markets turned into barometers of central bank liquidity, not real economic value. It's the same mechanism they used a century ago, only digitized and multiplied. Instead of gold reserves, we have confidence in government bonds. Instead of the gold standard, we have the dollar standard, where the globe must trust that U.S. debt is safe. Instead of interwar reparations, we have complex cross-border holdings of derivatives, securities, and central bank swap lines. The fragility is the same, only invisible. Look at how the system responds to stress today. In a crisis, central banks flood markets with liquidity. They buy bonds, they suppress interest rates, they coordinate across borders, the Fed, ECB, Bank of Japan, Bank of England, just as their predecessors coordinated in the 1920s. They promise stability, they insist everything is under control. But beneath the surface, debt keeps rising, currencies keep weakening, and the gap between real wealth and financial claims widens like a fault line before an earthquake. The hidden truth is uncomfortable but familiar. Modern central banks rely on controlled inflation to erode the value of unpayable debts. It is a slow-motion version of what wars once accomplished instantly. Destruction is no longer physical, it's numerical. Factories don't need to fall, the purchasing power of money does. If you compare 1928, 1971, 2008, and 2020, the pattern becomes unavoidable. Every system expands until its promises outgrow its collateral, whether that collateral is gold, productivity, or trust. And when that happens, the reset follows. Some resets are violent, some are quiet, but they come with mathematical certainty. We live in a world built from the consequences of the last reset, running the same playbook, hoping the numbers don't overtake us again. If you step back from the charts, the treaties, the acronyms, and the institutions, you begin to notice a pattern older than modern economics. Every financial system, from ancient Rome's silver denarius to France's assignat, to the gold standard, to today's dollar-based order, stretches itself until reality pulls it back. The tension always feels manageable at first. Then it becomes uncomfortable, then unbearable, and finally, something snaps. What makes these cycles dangerous is not malice, it's optimism. People believe growth will continue. Politicians believe promises can be rolled forward. Central banks believe they can outsmart the arithmetic. Nations believe cooperation can survive self-interest. And just when a system feels most sophisticated, most stable, most permanent, that's usually the moment it's drifting furthest from truth. We think collapse is dramatic, but it usually begins quietly. A mismatch between assets and liabilities, a currency imbalance, a debt too large to roll over, a trust that evaporates one institution at a time. The world of the 1930s didn't crumble because anyone wanted it to. It crumbled because the numbers exceeded the gold, the promises exceeded the resources, and the belief exceeded the mathematics. And here's the warning for you listening in 2025. Modern systems don't rely on gold anymore, but they still rely on trust. Trust in central banks, trust in government debt, trust in the idea that money created out of nothing will retain value as long as the right people say it will. That trust is powerful until it isn't. History doesn't repeat, but mechanisms do. When credit grows faster than productivity, when financial claims grow faster than real wealth, when governments grow addicted to debt that inflation must silently erase, the cycle enters its final phase. The illusion becomes visible, the cracks widen, and people start asking questions they haven't asked in decades. You don't have to be a pessimist to see where the logic leads. You just have to be honest about the arithmetic. Systems don't collapse because of bad intentions. They collapse when numbers outgrow gold, income, or trust. And the people who understand this early are the ones who survive the reset.